Now, the big stock in focus today will be Titan, as the company released its business update for the third quarter. A few key highlights of that update. The first one, of course, is that the fact the company says that they continue to witness strong customer momentum across all their businesses. So that is a positive. Now, coming on to individual segments, the mainstay segment of the company, which is the jewelry segment, out there the management said that they've witnessed strong same-store sales growth in the jewelry segment. That implies higher market share gains. And add to that, the company also said that they expect the jewelry division to do about 22% growth in the entire year, because customer demand was buoyant in the festive season of both Diwali as well as Dussehra. Now the wedding season is on. So 22% annual growth for the jewelry segment is something that the street would like, because remember, at the start of the year, company came out of the guidance of 25%. Then in June, they lowered it to around that 20% mark. And now 22% implies that the second half growth per quarter could be around that 30% mark, which is a positive. And leading that with higher same-store sales growth and added new stores, it would mean that the margins could actually be better than expected. Now, talking about margins, let's talk about the watches business. The company continued to witness customer traction. They launched new products as well as collections across the brands. And because of that, they've spent higher on advertising. And because of that, the EBIT margins will be substantially subdued. And that is something that the management had been telling the street right from quarter one. So that is something that is factored in. With that, the brokerages are fairly positive. So we have Morgan Stanley, which says that the management commentary underscores their outlook for a strong revenue growth. There is a chance that the margins in jewelry business may outperform. And we have Citi as well, saying that 22% growth in the entire year for the jewelry business is higher than their expectation of 21%. So they are positive, along with the fact that the pace of store expansion has picked up. Both of them have a buy rating on the stock. Macquarie has an overweight rating on the stock, and Citi's target price is close to around that 1,020 rupees per share. So expect some green on Titan.
Okay, Mangalam, thank you so much for that. So expect some green tick on Titan. But PMLA court declares Vijay Mallya a fugitive economic offender. Now his properties can now be confiscated by the government. Kevin Lee has filed a report on the same.
PMLA court here in Mumbai has declared Vijay Mallya the first Indian fugitive economic offender under the new act. What this essentially means is that now investigative agencies will be able to attach all of Vijay Mallya's properties inside India and outside as well, even if the funds that were used to purchase those properties are not related to the case of fraud that various banks have filed. This is not the end, however. Remember that there are 8 parties who are seeking intervention before those properties can be attached. The court will hear those pleas starting the 5th of February. After all of those pleas are heard and the court determines the ownership of these properties, only then will investigative agencies be able to attach these properties. So we'll still have to wait a bit until the actual attachment starts happening. Also remember that there are extradition efforts underway in Britain to get Vijay Mallya back to India. So we'll have to see what happens first, but a definite setback with the court now announcing Vijay Mallya a fugitive economic offender.
Absolutely definitive setback, as the court has announced him as a fugitive offender. With that, we move on to another story. The management of Radiant Life and Max India held a conference call on Friday. This is to discuss the details of the merger of Radiant and Max's hospital business. Here's the conversation we had with Abhay Soy, who's the chairman and MD of Radiant Life.
There have been some concerns on the valuations, whether they're actually a little more skewed in favor of Radiant. Can you help us understand how you arrived at that valuation figure of 7,000 crore rupees?
So, well, over 7,000 crore is essentially a combined value which has been estimated, and the valuation of Radiant is a combination of factors. It's the combination of the valuation at which KKR came in to Radiant. So that's at a valuation of 2,883 crores. And other than that, there has been a formula which has been applied by the independent valuers of the two companies, which is E&Y and KPMG as well, whereas valuation has been done on the basis of multiples as well as the GCF.
Okay, fair enough. Now, Abhay, what is the consolidated debt on the books of the entity, and what is the plan with respect to this debt going ahead?
So there are two things. I think the consolidated debt on the books of the entity is going to be about 2,200 crores. As far as the plans for the debt is concerned, obviously we are looking to ramp up the EBITDA margins of the combined entity as well in order to support that debt. So I think, in due course we should be, in the short to medium term itself, we should be fairly comfortable with in terms of the debt and the debt coverage.
Okay. Can you give us some sort of an outlook on consolidated margins? Where do they stand right now, and where should we expect them to be once this whole merger is through?
So at present, our Delhi NCR business is operating at about a 16% EBITDA margin. It's a young business. It was a hospital which has been commissioned in 2010. So at a 60% capacity utilization, we are operating at about a 16% EBITDA margin post our corporate overheads and all. As far as Max is concerned, it's in the public space what their present EBITDA margins are. How we are going to be operating at a higher EBITDA margin and in what time frame, for that we'll have to dig in a little deeper, because so far, it being a listed company, there has been, the access to information, at least the operating level metrics, etc., has been limited. But going forward, that's what we are looking to track at.
Well, on that note, let's slip into a short break. Up next, December Class 8 truck orders fall to its lowest level since August 2017. We'll get you more details on that on the other side of this short break. Stay tuned.